Well, Bruce Carnegie-Brown is chairman of Lloyd's of London, and he joins us here on set. Bruce, you have a really big business in the U.S. too. I know you're Lloyd's of London, but you're also like Lloyd's of London in the U.S., right? I mean,
so 50% of our business comes from the U.S.
So how do you manage climate change? What do you do when the storms are unpredictable, they come at different times, and they are catastrophic?
Well, so as a basic premise, insurance has a chance to reprice and restructure annually because people buy one-year policies. And we take in a new set of data each year and we add it to a long data set. And so if risks are linear, it's reasonably easy for us to adjust our models and continue to provide the insurance. If something exponential is happening, then the risk is that we're behind the curve all of the time. And that is potentially what is happening with climate change. So 25% of our capital is tied up in supporting natural catastrophe risks around the world, a big part of that in the United States, where the values are clearly very high. And so we worry a lot about these issues because it's not just a question of whether insurance is available, it's got to be affordable, otherwise people don't buy it. So there needs to be a partnership between government essentially and regulators to make sure there's enough resilience in the economy that the losses we're protecting against are unexpected, because the model breaks down if the loss is expected.
But I am curious, I mean, when you talk to your members, I mean, we've already seen insurance companies themselves pull back in certain markets. We've seen the reinsurers pull back. I mean, to a certain degree, there are certain parts of this country now that are completely dependent on the government and regulators to either provide their insurance or at least to subsidize it pretty heavily here. Is that actually something that works in your business model, or is that something that's going to be completely separate?
No, well, governments, we do need to partner with governments in many cases, particularly around systemic kinds of risks, which I think climate would be one, cyber would be another. The risks are just too big for the insurance industry alone to support. But the real issue we need is behavioral change. You know, people need to build in different places. They need to build with greater resiliency. Most building regulations are pretty tough in the United States, particularly in hurricane-affected areas, for instance, or natural catastrophe-affected areas. But what's happening is places that didn't used to be natural catastrophe-affected areas are now experiencing these things. Germany is quite a good example of this. Nobody thought of Germany as a natural catastrophe environment, but they now regularly have extraordinary flooding and hailstorms through a given season.
I am curious. I mean, outside of weather and climate change issues, there are a lot of other issues swirling around here. I think we were just talking during the commercial break here about the advent of AI, some of these new technologies here. This in and of itself has become an insurance risk.
Yes, so we're on both sides of the ledger. We can use AI to be smarter about the risks that we underwrite, but equally AI is going to be used by bad actors to break down the security defenses of our customers, and that will result in greater claims. And so we need to begin to understand this and how we can support our customers going through that. But interestingly, so the first ever cyber insurance policy was underwritten at Lloyd's in 1999. So the industry for insurance is only 25 years old. And in the beginning, people described it as a bit like a homeowner's policy where you could leave the front door open and you still had to pay the claim. And a bit like you wouldn't expect to get homeowners cover today if you don't have a burglar alarm or mortise locks on your windows. So we're beginning to have conversations with our customers about how they mitigate against these cyber threats. And of course, the value of doing that is to build resilience in the overall economy against the risk of cyber attack.
What's your relationship like with your reinsurers to then help your customers in terms of these threats?
Well, so, we lay off some of our risk, which is where the reinsurance comes in. We actually do reinsurance ourselves for other insurance companies too. So this is about sharing risk in order to be able to provide meaningful amounts of cover when a disaster happens.
Where in that process do you feel is the biggest gap between the pricing that you need to mitigate your risk versus the pricing that customers, whether it be homeowners or a company, can afford to pay? Where is that gap the largest?
Well, it develops in different ways around different risks. So, I was challenged yesterday by somebody who said their homeowners policy had gone up 40%, and why was that? And, it's four things, or three things really, that are key there. The first is the value of their property has gone up, so the cover is greater. The second thing is with persistent inflation, we've had replacement costs going up, both materials and building contractors. And then, of course, the overlay of natural catastrophe risk has increased as well. Now, if it goes up too high, of course, the owner stops buying the cover. That's not good for us, and it's definitely not good for them.
When you look at some of the bigger sort of structural changes out there, the ones that will have an impact either on your members' businesses or just really the insurance industry writ large here, what is most important to you right now, most important to watch?
Well, we've got to respond to changing risks that our customers face. So one of the things, if you've been insuring bricks and mortar for 200 years, you've got to wake up and recognize that in an enterprise value of most of the businesses we look after, bricks and mortar are a smaller and smaller part of it. And they're increasingly valued on intangible risks. And so, we now develop products to support outages on platforms in the cloud, because these are bigger risks for many companies than whether their inventory burns or their buildings are knocked down. So what we've got to do is innovate around the changing risk landscape.
All right. Well, fascinating stuff here. I really appreciate you stopping by today. Bruce Carnegie-Brown there, chairman of Lloyd's of London.